Let me just clear my throat. Early in the morning for me. I woke up this morning and I was like, oh my God, the sound of my voice is horrible. Let me have some coffee. Probably still sounds a little bit too early for me. Nah, I was up about an hour and a half ago. Went to bed late. Thanks, Steve. Now that I have a new baby around, the dynamic at the house is a little bit different, but loving it. So as we trickle into 9 a.m., we'll let the rest of the attendees come in. So any questions for members? Any questions? I posted a link in the private Twitter feed. If you had any specific questions. Good morning. Just post a response or reply to the post that I posted inside the private Twitter. And then if I don't get to answer it during the webinar, I will take a look at it afterwards and make sure I get to it. So if there's any questions, just post them in there. Otherwise, this webinar is going to be meant for just reviewing what happened in the markets this week. Because if you've opened up the report that I posted in the private Telegram channel yesterday and read through it, you'll see that based on all the evidence of what has transpired over the last few weeks, we might be getting some really good opportunities in the markets coming very, very soon. Did most of you get a chance to read through the report? Just so I know where you're at. Just give me a Y or an N. Let me know. Katerina, good. Yeah. Good stuff. Yeah, for me, it's essential to do these reports. And, you know, I've been doing these reports for years. I was doing these reports when it was just for myself, okay? Because I realized that to have the right frame of mind entering into the markets, I had to be confident in what I was observing in the markets. And so, you know, at the beginning, when I first started trading, I started, you know, the weeks off without being properly prepared. I'd review my charts and all that stuff, but I never had any solid ground to stand on. I'd review my charts and say, oh, okay, this is what I'm looking for in the markets. And here's the trade setups that I'm looking for. And then when it came time to trigger, I would second guess myself and I would think to myself, did I miss something? Is there something I'm overlooking? So I started to realize that, you know, if I wanted to take my trading serious, I had to approach it with, you know, more seriousness. So I started doing these reports for myself and started collecting. Well, I've been collecting the CFTC data for years now, and so I started collecting the data and putting together my thoughts. You know, every weekend I would set aside 4, 5, 6, 7 hours, whatever it took, to just examine the CFTC data, examine the charts, and put all my thoughts into writing. That way, it was solid. It was something that I could reread and go back in the past and read the previous reports and see where I was right or wrong with my analysis. And I found it to be extremely helpful. So, I mean, I was doing the reports, you know, just for me, for all this time. So it's great to be able to share this with others now. So yeah, for me, it's essential before the week starts to get this report done and have it fresh in my mind. All right, so let me just taper off the classical music that I like to listen to. You guys enjoy classical music? It's nice, right? I usually put it on when I'm trading, just to put me in the right frame of mind. All right, so boom. let's take a look at the markets and see what has transpired. So if you read the report, you'll know that I've been expecting gold for quite some time to drop like this, right? And we got that drop, and right now we're sitting within a weekly area of demand. But remember, we were able to determine that this weekly area of demand was an area that the institutions were using to close short positions and not add to long positions. So we know that this area is going to be taken out. And we know that eventually price is going to drop down to the next weekly area of demand down here. And so that would mean that price would dip deeper into this already tested area of monthly demand. Remember, it was tested here, and then we got a deeper penetration. Now we're getting a deeper penetration. So we could see a bounce like this. Okay, so a move lower down to here and then a bounce upwards is very possible. But I think if we do get a bounce upwards, it's going to be short-lived up towards this area of weekly supply and then a move lower. Okay, so that means weakness in gold and then potentially some strength up until this area up here. And if you notice, where's that trend line? Right here, weekly momentum shift. That'll be huge. If price does actually play out like this up here, I mean, there's no stopping how far down this is going to drop. Okay, I think over the long term, we're going to see price come down to these areas, the 1122s, maybe even lower. All right, and oil. So oil's been a real tricky one, hasn't it? So we see right here, we got that daily momentum shift over here, which pushed price lower. Then we got that reaction off of the 20 EMA. Remember that force of the 20 EMA coming into the markets, pushing price up and making it react up here. So pay attention to what happened here, right? So price dropped into that weekly 20 EMA, and then we got a weekly force pushing price up. Okay, and then I said that this area of supply, be careful taking shorts there, because we have a weekly 20 EMA pushing up on price, and weekly forces are more powerful than daily. And take a look what happened. It ended up being taken out, and it needed another weekly force to push price back down. So what did we have here? We had that weekly supply imbalance here. So that's a weekly force. So it came right up to that weekly force and then reacted to the downside. It took out this area, that daily momentum shift to the upside. Why? Well, because now we have a weekly force pushing down on price. Weekly force pushing down against a daily force. Weekly typically wins. And now we have a drop down, and what is stopping price? Another weekly force. So you can see very clearly on the weekly chart that price is just responding from weekly forces, weekly supply forces to weekly demand forces. 20 EMA, first it was the supply imbalance, 20 EMA, another retest of the supply, now the ascending weekly trend line. So the question remains, what is going to happen with oil? We know that by taking a look at the CFTC data, okay, we know that the institutions are heavily long biased, right? They've been heavily long biased for quite some time, and shorts are cooled off, okay? And 88% of their overall exposure is geared to the long side. So are we going to start seeing a drop from these highs? It's possible. We've already seen some massive profit taking, right? Just back in April, they had 840,000, 850,000 positions, and now we're down by 100,000. So that's pretty decent. They took about 100,000 off. But what is going to create a shift to the downside here? We got that weekly trend line holding up price. We know that the daily is in consolidation, so there's nothing holding up price right now on the daily chart. Now we got that weekly trend line right here. That's what we have to contend against now. If we get this break of this weekly trend line, price comes down and tests this area of the weekly demand and breaks that trend line, we'll have supply up here, although improperly formed, but that could be what will end up propelling price like this, because for sure, price will eventually get down here. Okay, we're coming up against that higher time frame trend line. The only thing that I don't like here is the distance between where price is now and that higher time frame trend line. Okay, there's still quite a distance in between the two, which leads me to believe that we are more likely than not going to get another push to the upside. But if that push to the upside happens, it has to happen off of here. Okay, so this week going into the markets, what I'll be watching for in terms of oil is what happens here. If price starts to penetrate here and do this type of move like that, then that idea of price moving upwards even higher is going to be out the window for me. Okay, it's just not going to be in existence right now at that point. And again, the reason being is because if price was going to make a move up, it's going to be off of here. Okay, once price gets down here to this weekly area of demand, you can obviously see that that weekly ascending trend line is going to be heavily penetrated. Will it be broken? Not necessarily, because if we get one big candle coming down like this, you know, to test it, you know, one big candle going down, the trend line is not going to be broken. It'll be penetrated but not broken. So we could see a reversal, you know, something like that. It is possible. But so that's what I'm watching for, because this trend line's holding right now. We could get a move down here. We could even get a momentum shift, and then price go even higher. It depends. Okay, it really does depend. And what I'll be watching too is the US CAD to see how it reacts from that monthly area of supply. Okay, but what I want to go through right now is I want to show you how all the markets are properly aligned. If you didn't get that come across to you in the report, then I want to make sure that it does come across to you in this webinar, because then it'll start to open up your minds to the possibilities, and you'll start to see how all the markets are correlated with one another. Okay, so let's take a look at the US dollar right now. So the US dollar has been doing a bunch of nothing for quite some time. All right, but remember, the markets go through certain phases, right? We have the markets, and they go through phases of accumulation, and the markets go through phases of distribution. So the banks, the institutions, they come in, they accumulate a position, they take their time doing that, they buy, let price come back down, they buy more, and when they're done buying, they allow it to jet to the upside. And then when they get to their targets, they offload their positions. So let's take a look at if that's the case here, right here. So when we take a look at the date here, that's May 29th. So in May, let's take a look at the CFTC data with the US dollar starting in May. Take a look at their positions, okay? So May, we see that 30,000 positions were for long and 27,000 positions were for short. Okay, and so what has happened since that time? Okay, since here, this area here, to here. Okay, so we can see that during this time that price has been consolidating to the side, the institutions took their positions from 30,000 to 37,000. So at the end of the day, they're accumulating long positions, all right? And they also took short positions from 27,000 to 18,000. So this is not distribution. This is actually accumulating, right? They're accumulating what? They're accumulating a long position. All right, because they had 30,000, now they have 37, and they're getting rid of their short positions. Now, we've known for quite some time that they've been very aggressive with their shorts for quite some time. And over the last 1, 2, 3, 4 weeks, they become less aggressive with their short positions. So we know that they've been offloading their short positions and slowly building up a long position. And doesn't that match perfectly with what we've been suspecting for quite some time, right? That price is eventually going to come up here and even higher. It does, right? So again, we noticed that back in June 19, when the contracts were expiring. What did we notice? A massive decrease in short positions from 30,000, and then they opened up only 19,000. So we knew right then and there was a big hint that they're making a massive shift from being overly exposed to the short side to starting to accumulate a large long position. But the thing is this, if you take a look at the charts, we know that the monthly chart right now is in consolidation, at least based on my rules and the way that I draw trend lines and we look at the zones. Okay, price is in consolidation. And then we look at the weekly chart, and weekly is in consolidation. So what happens when the charts are in consolidation? They move from zone to zone, right? There is no structure, ascending trend lines, no nothing, to cause price to move in one specific direction and hold that direction. All right. So take a look here now. So we know that we are reacting from this weekly area of supply right here. And we know that we have this weekly area of demand down here. Now remember what this weekly area of demand was? It was the cause of a momentum shift to the upside. So typically when we have a situation like this on a weekly chart, and price is in consolidation, when price hits weekly supply, it tends to drop to weekly demand. Okay, that's typically more often than not what takes place. So I've been expecting a drop like this for quite some time, right? But if you look at the CFTC data, okay, if you just look at the data, you'd say to yourself, well, the institutions are accumulating a long position, so they want price to go up. Okay, they're getting rid of their shorts and they're accumulating a long, so they want price to go up. If you just looked at it and thought and interpreted the data that simplistically, then what would happen is you would be determining that price is eventually going to go higher like this from these areas. Okay, and we can't read the reports that way because we have to look at the bigger picture, right? We have to remember that they have been extremely short biased, okay? And so if they are going to take price from here to here, if they know that price is going to go up here, what they want to do is they want to offload all those shorts that they've been holding all throughout this drop down here. They want to offload all those shorts, and they want to start to accumulate a long position. So is there any signs over the last couple of weeks that we may see some hedging, right? Down to 19, up to 21, down to 18, not quite. At least not with the US dollar, okay? And if you go through the report, you'll see that on another pair, we are seeing signs that the institutions are starting to hedge, okay? And we'll get to that one. So that one is, that pair is revealing its cards to us because we're seeing exactly what the institutions are doing. We see that price is moving to the upside, but they're starting to hedge a position, okay? We'll get to that pair a little bit later on in the webinar. But what I want you to realize is this. If you take a look at the coloration of the cells here, okay? This coloration of the cells takes into consideration data that I've collected from the institutions going back to January 2005. All right, we're in July 2018. So I've accumulated data going back to January 2005 of all the positions that the institutions have been holding, okay, on longs and shorts. And so this indicator here is telling me that based on previous positions, the coloration of the cells are telling me that they're starting to become aggressive with their long positions, okay? We used to be very aggressive with shorts. They're starting to become less aggressive. So this is only beginning to be aggressive, okay? Beginning to be aggressive. Now, from what I've observed over the years from the institutions, if they're going to be preparing for a move like this, it's not unlike them to see a move come back like this, accumulate more of those long positions for a move like this. In fact, what we could even see is as price starts to decline here, is they start to add longs and shorts, okay? That's typically what they do. As price drops, they add shorts and longs because as they're adding in those longs, they don't want to be taking a loss on those longs, right? So what they do is they add shorts to counterbalance those longs that they're opening. And it's very smart because when price gets down here, they close all those short positions for profit. And then, well, actually, it depends on how many of those short positions that they've opened. If they've opened more short positions than they have long, then they'll end up closing those short positions for profit. And it will be as if those long positions that they opened up here, here, and here, their average price will be down here. Okay, so it's pretty ingenious how they do this because they have such huge positions, right, that they have to get into their massive positions without taking any losses and without moving the markets too much against them, right? Because remember, when they buy, price goes up. So if they want to accumulate a long position and they're buying, price will go up here. Do they want to buy here or here? They'd rather buy here, right? In fact, they'd even want to even better to buy lower. So they open up shorts, causing price to drop, and they open up longs at the same time. But ideally, what they'll want to do is cause the news, media, economic data to trigger retail traders to buy when price is doing this. Okay, when they're planning on price doing that. Okay, so what I see here on the daily chart is a great indication that what's going to be happening with the US dollar is this. Okay, you know, momentum is just shifting here. Okay, so we got that daily structure still holding, daily ascending trend line, and we have a daily demand zone here that price reacted from, and we have a daily supply zone that on Friday, we got that reaction like this to the downside. So what I'm going to be watching for is this key area right here this week. Okay, we have that ascending trend line that could either be used to hold price and then we see a move like this, or we're going to see a penetration of that trend line, possibly a penetration of this daily area of demand, which will end up leaving a momentum shift daily supply zone, which could be what triggers a larger move down like this. So I'll be ready and very willing to take a short position if I see that. If I see that trend line be taken out by the institutions and then their own demand zone being taken out, then it's more likely than not price is going to take a dive like this. Okay? But this trend line is going to be key because we know that a lot of retail traders have that trend line. And once price gets down here, retail traders are going to be buying. All right. So they'll have to fill in so much of their short positions that it'll be enough to take out the demand that comes into the markets from the retail traders. And then we'll have new supply formed because they'll take out a demand zone. And what would be nice is if they took this demand zone out too, and then reacted from here and up like this. That'll be a perfect short. Because if this happens, if price plays out exactly how I showed you here, it takes out this demand, and then reacts from this demand, which is the demand that was used to take out a weekly area of supply. And then we get this push up. I will short this sucker all day. Okay? Because 9 times out of 10 that will happen like that. So I think everything is looking good. If we just based this idea of this move to the downside off of the CFTC report, we wouldn't be able to see that this is going to be taking place. Okay, because we see them accumulating longs, and we'd be thinking to ourselves, you know, I don't think this is going to be dropping. It looks like it's going to go higher. But I think, you know, there's a very good chance that this is what's going to be playing out. Okay, so let's take a look now at the other pair that I was mentioning to you that is showing me signs that some hedging is taking place. Let's take a look right here. US dollar, Japanese yen. Did you guys see that on the report? That big increase that they just threw in there from 49,000 to 60,000? What a big increase in short positions. Okay. So let's take a look at what they're doing here. So we've been expecting this move to the upside for ever since down here, right? Look at that. That was the entry here on the weekly chart right here. Entry right at the turning point, 104.64. Okay, first target here, and we just fell short of hitting that first target right here. So we've been expecting this move to the upside for quite some time. I was saying that as price was dropping, I would want it to create a foundation for us to get in long. Here's that foundation that was created. Price fell short of coming down into it, and we just got this break to the upside. So now what's happening? So we have that descending trend line here, right, on the monthly chart. And when you map that out onto the weekly, it's right here. Okay? And you can see that on the weekly chart, we are deeply penetrating that trend line. So that's a good sign. That's an early indication that we are eventually going to get a break of that descending trend line. I'm not concerned. I do know that eventually we're going to get price to come all the way up here. All right. So we see that push to the upside. We have a weekly area of demand being created that took out a weekly descending trend line, and now it looks like it's going to be responsible for removing this descending monthly trend line here. Okay, so that is looking good. And so the daily structure is to the upside, and now we're just falling short of hitting some daily supply. So let's take a look at the CFTC data. So this consolidation candle right here, if you guys can see, let me just clear up the charts. See this consolidation candle right here? Okay, so right there is where the institutions increased their long positions, okay, which ended up causing a big explosive move to the upside. But at the same time, they increased their short positions. Now, here's the reason for why they're doing this. There's only one of two reasons, and next week's data is going to be essential to help us understand exactly why they increased this big amount here. Now, I have reason to believe that this is the starting of some hedging. Okay. So why would they increase such a large amount of short positions as they're increasing their long positions? Well, here's the reason why. Because again, what I was mentioning to you is that when a large amount of demand comes into the market, it causes the market to rally upwards, all right? And if you're trying to buy and you're trying to keep prices artificially low, if you bring in supply into the markets go down. If there's more supply than demand, markets go down. If there's more demand than supply, markets go up. So if you bring in supply and demand at the same time, then you can open up your long positions without causing a massive move to the upside, forcing you to have to buy it at higher prices. Okay? So you're able to accumulate long positions at a better price while opening up short positions. But then you're thinking to yourself, well, why would they be opening up short positions at the same time? Because if price continues to go higher, then those short positions are going to go in the minus. Well, that's just the thing. They know that it's not going to go higher. Okay? Why is that? Well, because we're hitting supply here. Okay? And US dollar. What's the US dollar doing? Losing momentum. Where? At a weekly area of supply. Okay? What's the US CAD doing? Hitting monthly supply, right? What's the US Swiss franc doing? Hitting supply, inside supply, losing momentum, right? So the institutions know that the US dollar pairs are all within supply zones. their own supply zones. That's why they're adding their long positions, because eventually they know price is going to be taken up here. And they're okay taking all these short positions because they know all the US pairs are hitting supply. So there's the expectation that there's going to be a drop. Now, ideally, what I'd like to see is a push a little bit higher, because I want to see on the weekly chart price come up to about here, where it was previously tested here, this weekly area of supply, consolidate to the side, and then drop. And the reason being is because we have this beautiful area of demand right here. And if we get a move a little bit higher up and some consolidation, that will just make this demand zone here valid for a long trade. Okay, and I'll take longs here any day. And so pay attention to this. Okay, so if we get this consolidation up here, we have this beautiful weekly area of demand, right? Now let's go and switch to the US Swiss franc. Do we not have something like this down here? Weekly momentum shift demand zone, right? Price is losing steam. Are we going to get a drop like this? Who knows? Maybe, maybe not. But if we do get that drop like that, definitely take longs here any day to ride up, because we know that price is eventually going to go higher, right? And so if we take a look at the US CAD, we have a weekly momentum shift here, right? That took out this descending monthly trend line. Only thing is that the drop from here to here is very short, okay? And if you look at the Swiss franc, it's very large. If we look at the US dollar Japanese yen, if we got a move up here, it would be somewhat a larger drop as well. But considering this drop here on the US dollar, take a look at the drop that we have here, right? We're hitting that supply. Look at the drop that we have until demand. It's quite significant. So that leads me to believe the US dollar drop is significant. The US CAD drop is not. US Swiss is significant. US dollar Japanese yen, depending how it plays out, it could be significant. So that tells me something. That tells me that if price does drop here to this area of demand, I have to be very careful taking longs there. Okay? Because if it was to drop just like this, that could take 2-3 days to do that. 2, 3, maybe 4 days, right? But then you take a look at the US dollar. How long do you think it would take for price to drop from here to here? It could take weeks. 2, 3, 4 weeks it could take. Even more. I mean, look how many weeks it took. 1, 2, 3, 4, 5, 6. 6 weeks to get up here. And that's as the institutions were accumulating a long position. So how long is it going to take to drop? We don't know. But it's definitely going to take longer to drop than it would for the US CAD to hit that area of demand, right? So if price gets down here, the only way I would take a long position here is if I see a momentum shift to the upside. Okay? And I think I posted that in the report. And that's the reason why. I mean, although I think this is a great area to go long in, I'm not going to just set orders here, a buy and a stop loss, and take it blindly. And that's the reason why, is because we could see a bounce and then a further move to the downside. Anything is possible, because at the end of the day, we do have a monthly area of supply and control. Even though I believe it's going to be taken out, and we're going to see something like this, we don't know how much of a drop we're going to get. All right. Let me see. Private Twitter feed is quiet. Wow, no questions from you guys. So you guys have been following along pretty well, I guess, huh? Let me take a sip of my coffee. Are you guys following along so far? Was what I wrote in the report pretty straightforward? Yeah, it was. Great. Good. When a short contract is created. George? Yeah, George, send me your question through the private Twitter feed. Send it as a response to what I posted there. Sinking in slowly. Good, Steve. When a short contract is created, do the institutions it'll take you forever to write the question under this section here. Yeah, so it's best to just write it on the private Twitter feed. So I'm trying to follow. Good, George. Nice. So let's take a look here at the Aussie. Okay, what do we have in the Aussie? We have that. I'll be watching for your question, George. So the second, oh, let's see, is it up already? Let me see if your question came through. Oh, nice, buddy. Good. All right, so I'll be waiting for your question, George. So we see something here. So this is a good indication for me that that reversal is going to take place. Okay? Because as I've always been pointing out, we always have to look at the other charts to see which one is taking the lead. Okay, there's always a chart taking the lead with price, and so we have to see which ones are taking the lead and which ones are going to dictate the direction of price. And so if you take a look at the Aussie, we know that this previously tested area of monthly demand is in control. So there's a massive force pushing price to the upside. Okay, massive force. And we have this weekly ascending trend line that was broken with this supply. It got contacted and we got the drop, and now we're seeing all these candles here forcing price to the upside. So we're probably going to see a move like this to that area of supply and then down, deeper penetration to here. But overall, I think we're going to have a stronger Aussie than we will the euro. And let's see, the euro, the pound, not so much. This one's a little bit tricky because we have that monthly area of demand just a little bit further down. But if you take a look at the euro, I mean, this sucker's got room to drop. Okay, so you see how far away any type of monthly demand is on the euro. Okay, and you look at the Aussie, we are in demand. Okay, so you can obviously see that there's going to be more strength on the Aussie than there is with the euro, right? So what does that tell us? We should be shorting the euro Aussie, right? Because the euro is going to be weaker. And so I was looking at this pair last week and I was like, wow, that makes a lot of sense here, because look, we got that weekly area of supply in control right now, and we're starting to see this breakdown of price action. Okay, price came down, tested this area of demand, got this very weak push. If we get this break of this 4-hour demand zone here, we could get a pullback to the supply and then see a drop like this take place over the next couple weeks. Very possible. The only thing that would stop us from seeing a bigger drop is this area of demand. So we'll see at least a drop to this area of demand here, this daily area of demand. So these would be short targets here. So this area of demand gets taken out, short target is here. For me, that's what I'm seeing. Let's see if that question came through. Let me read through it. When short contracts are created, did the institution create it, or is it made by the commercials and they borrow it and then cover in the future? So the commercials are separate. I'm only looking at what the institutions are doing right here. I'm only judging it off of this information here. So this is the non-commercials. So this is your hedge funds, institutions, banks that are trading and they're speculating in the markets. They're placing bets on the direction that price is going to move in, and they are looking to make profits based on judging if the direction is going to be up or down correctly. So I'm not looking at commercials. Commercials are this section here, and those are the big corporations that are hedging against real positions that they have in the markets. Does that answer that for you, George? So the institutions are always holding both massive long positions and short positions. They're always holding both sides. And the number one reason for it is to help them move the markets in the directions that they need it to. Real positions in the markets, please clarify. Real positions in the markets. Oh, okay. So like, let's say, you know, like a corporation that has multiple offices all over the world, okay? And they need to pay their employees in American dollars, right? So they know they have to pay Bill $100,000. The commercials, yeah, the commercials. Those corporations, they have to pay Bill $100,000 every year, right? If the US dollar goes up in value and their company is located in Canada, if the US dollar goes up in value, then do they want to have to pay Bill $125,000 because the US dollar went up in value? They don't want that, right? So what are they going to do? Is they're going to hedge their position so that in case the US dollar goes up, they're going to be making profits in the markets. And so when it comes time to pay their employee, it's going to cost the same amount of money. Okay, so for in that instance, what are they going to be doing? They're going to be buying the US dollar, thinking that it's going to go up. So in that case, they won't be going against the markets, they'll be going with the markets. But in a better explanation would be oil, okay, or coffee. Starbucks sells coffee, right? If the value of coffee goes down, you know, they want the cost of their coffee to always be the same, no matter what. If the value goes up, it costs them the same. If the value of coffee goes down, they want it to cost them the same, no matter what. Because if the value of coffee goes up, they're not going to change the prices in their Starbucks stores and say a cup of coffee is no longer $4, but now it's $6. So what do? If they think the price of coffee is going to go up, they're going to short it. Okay? So that they will lose money. They'll lose money when they short it. They short coffee and it goes up, but they'll make it on the value of them. Let me think this clearly. Now I'm getting confused here. Yeah, when the value of the coffee goes up, they lose in the real market, but they're gaining from what they actually have. So if somebody has gold bars and they want the value of those gold bars to stay the same, if gold goes up in value, they're going to short the actual market so that that gold that they own remains the same value, right? Yeah, garments, everything, cotton, all that stuff, it's the same thing. So they're owning the physical product, but they don't want the value of that physical product to move. Okay? It's just like if you read Ray Dalio's book, he explains how he used hedging in the markets. He was one of the first guys to introduce hedging to the big corporations, and it was with McDonald's. So McDonald's wanted to sell chicken nuggets. Okay? But they said, well, what if the cost of chickens go up? Then what are we going to do? We're going to, have to charge more money for chicken nuggets. We can't do that. So he said, well, we'll just find, how can we hedge you with chickens? Well, we'll find whatever product we can invest in the markets that are used to grow chickens. And in that case, it was with the feed. I think it was soy that they were feeding the chickens. And they hedged their physical chickens with soy. So basically, non-commercial are not out to make money with markets going up or down. They're only opening up positions to help them hedge their physical positions. Okay. So they're not looking at it as, oh, I have US dollars, but I want my $100,000 US in my account to go up in value if the US dollar goes up. No, they want to short the US dollar if it goes up because they want that $100,000 in their account to stay the same. So if they short the US dollar when it goes up, they're losing value on their positions in the markets, but they're gaining value with that $100,000 in their bank account. Okay? That's what I was trying to explain to you with the paying somebody $100,000 salary. Okay, so that $100,000 that the corporation has in their bank account set aside to pay an employee, they're going to hedge that $100,000 by shorting the US dollar, because if the US dollar goes up in value, then that $100,000 in their corporate account goes up in value, but they're losing the value by shorting the US dollar. So at the end of the day, the value of that $100,000 stays the same. So they're not interested in making money. They're interested in just keeping everything regulated the same, so that no matter what happens in the markets, they always know what's going to happen with that $100,000. They always know it's going to be keeping its value. So that's why paying attention to commercial is not very important, even though I don't know why everybody teaches this online, and there's books that teach you that the commercials are the big players and you got to focus on what they're doing. I mean, yeah, okay, they are the big players. They do have a lot of money in the markets, but it's not for the purposes of making money. We're in the market for making money. So if you're looking to make money based off of what commercials are doing, you're always going to take the opposite side of what the market's doing. Sometimes you may get it right, but that's only when price is transitioning from dropping to turning to the upside. And you may look at the commercials and say, oh, look, let's take a look at the US dollar, for instance, okay? So what do we see with the US dollar? Longs are 1,000. Let's look at the euro, bigger numbers. So longs are 217,000, shorts are 247,000. So in this case, they have more short than they do longs. Okay? So anybody just looking at the commercials, they're going to say, yeah, they're right to look at the commercials because they have a bigger short position than they do long. And at the end of the day, everybody's thinking that the euro is going to collapse, right? So they're opening up short positions here, because commercials have bigger amount of short positions than they do long. If you do that, you're going to be in big trouble, right? You're going to be in big trouble. How many people were looking at the COT report saying, oh, commercials, they have more short than they do have long, and then sold on the break of this low? You don't think that was all done on purpose to trigger people to sell? I mean, when you go to the bookstore and you look at trading books, and you look at what they teach you for technical analysis, it's always the same stuff. Breakouts and trend lines and support and resistance and all that stuff. And again, all that stuff is great if you have enough experience in the markets to know how to put all that information together to give you an edge in your trading. If you are aware that most breakouts don't work anymore, and you know that that's not the way to trade, then you're not going to be tricked into this. But how many traders are being tricked into that? How many traders are looking at the COT report saying, oh, commercials have more short than long, so that means they're going to push price lower? I mean, if you just look at the markets and the data that simple, you're going to find yourself in big trouble, because it's not that simple, right? So I rarely pay attention to commercials. Sometimes I do, but what I use the commercials for, and I was asked this question just this weekend, what do I really use the commercials for? Well, since I know the commercials are usually more often than not, way more often than not, taking the opposite side of the market in terms of positions, then for me to get a bigger grasp, so think about it this way, okay? So if the institutions know that the euro is going to drop, okay? If they know that the euro is going to drop like this and then eventually take this out and go even lower, okay? Let's say they all know that. At least the big players, the really, really big players, okay? They know that that's what's going to happen. That means the non-commercial know that that's what's going to happen, and the commercial side know that that's going to happen, right? They're not going to be guessing in the markets. This is, you've seen any members here that have been following along since the service started. You've been seeing in the reports, and you've been seeing through the videos that I've made. You can see that this is very calculated what's going on in the markets. This is not random. What they are doing is very, very calculated, and it makes complete sense. When you analyze their positions, you can determine what they're going to do with a great amount of accuracy, because it's very calculated. They're not guessing. They make it seem like the markets are random, but the markets are not random. Okay, they want us to believe that they're random, but they're not. So if the non-commercial and the commercial both know that the euro is going to drop, then wouldn't it make sense to pay attention to the commercial? It obviously makes sense, right? But would you not take a look at the data and basically reverse it? So you can see here that I have this column here. That's called the difference, right? And so what this column does is it takes this number here, which is the net positions of the commercial, non-commercial, and it combines it with the net positions of the commercial to give me the true sentiment of what the non-commercials and commercials are thinking. Because if the non-commercials know that the euro is going to drop, then what do they want to do? Do they want to have more positions short or long, right? They're hedging, so they want more long. And that's what we're going to start to see, okay? You can see here, non-commercial longs have been aggressive. All this time, commercial shorts have been the more aggressive one, right? We're starting to become more aggressive short. They are starting to become more aggressive long. So it's always the opposite. I mean, 9.8% of the times, or sorry, 99.5% of the times, this is what happens, okay? Always the opposite. So what I do is I take what the non-commercial are doing, combine it with the commercials to give me an overall sentiment. Because sometimes, if you're just looking at the non-commercials, it's not very clear, okay? And at those times, I look at the two numbers combined together, and many times it helps me out with determining what's going on. Okay? So that is how I use that. Let's see if there's any questions that you guys have. Okay, good question. I get this question a lot, and I thought I answered it on one of the videos. When you are entering the CFTC data from the website, why do you usually flip the numbers as you mentioned in your video on YouTube? Okay, so why do I the flip of the US dollar pair data from long and short? So as you can see here, I have CAD, Swiss franc, yen, long and short figures have been reversed from original futures numbers for ease of use. The basic reason is this, guys, because the CFTC data is for futures contracts, right? So if you buy a futures contract on the Canadian dollar, if you buy it, that means you think it's going to be stronger, which means price is going to go higher, okay? But what happens is if the US CAD gets stronger, what happens on the US CAD chart? Does it go up or does it go down? It goes down, right? CAD gets stronger, the US CAD goes lower. But if you take a look at a CAD futures chart, if the CAD gets stronger, it goes up. Okay? So because I know that the institutions are those numbers are for futures contracts, if I see that longs are increasing, then that means for the US CAD, it's shorts that are increasing. Okay? That's why I reverse it, because if I didn't reverse it, it would just confuse me. If I put, you know, the institutions are increasing long positions on the CAD because they're thinking that the CAD is going to get stronger. If I just put here on my US CAD chart, longs increasing, then I would get confused because I don't trade futures. I only trade the currency pair. So I switch the numbers because it's basically they are shorting the US CAD. Does that make sense, bud? You only go with, yes, good stuff. I only go with the commercials when there's a big divergence between them and non-commercials. Yeah, good stuff. Yeah, right on. Okay, so I think somebody was asking me to take a look at a pair. Can you take a look at Euro Aussie and Pound Aussie, please? Thanks a lot. So we looked at Euro Aussie, right? I said that there was a good chance that price drops. Why? Because I think that the Euro is going to get weaker than the Aussie. So if this area of demand gets taken out, it's going to open up for a move like this. Obviously, there's going to be some hesitations here, especially here. So we could see that, something like that. But I think the chances of a bigger move to the downside is greater. Pound Aussie, what do we see here? So we have that momentum shift too, same as Euro Aussie, right? Look at that, weekly momentum shift and weekly momentum shift here. Supply is in control. But here's the deal, if you look at the monthly chart, monthly trend is up, okay? Yes, we had this bearish engulf created on the monthly, which is telling us that price most likely wants to decline. And with this momentum shift, there's a good chance that we see that. But here's the thing with the pound, right? If you take a look at the pound, yes, does it want to drop? Well, we're getting that momentum shift right here, okay? Which is, and this is already tested, so that opens the doorway to for a move to this daily area of supply here. So that means pound over the short term, more likely than not, can get strong from here to here. So pound Aussie, both Aussie and pound are strong. This is what happens, okay? Consolidation like this. Yes, at the end of the day, we are in a weekly area of supply, which tells us that it's more likely than not we're going to see a drop like this, but this is messy. I'd have to see this area get taken out first, and then potentially a drop like that, okay? Because it looks like the pound is going to get weaker than the Aussie. But it's hard to tell because, you know, taking a look at the monthly chart, we got this trend line broken. So there could be some demand here. You know, this is very speculative over here. I don't like this, how this looks here, but there could be demand here. So I'm being very cautious with thinking that there's going to be a drop on the pound just simply because of that. Okay. So that's it. If there's any other questions, one more question coming through. Lance, let me see. Do the short and long contracts have the same value? For instance, if an institution opens up 1,000 contracts short and 1,000 contracts long, do they have the same value? Like, how do we know what the cost of the contracts are? If they open up 1,000 contracts long and 1,000 contracts short, we don't need to know the value, okay? We don't need to know exactly where they bought it. You know, we just look at the area that they bought it at, and if we know that they're buying 1,000 contracts and selling 1,000 contracts, that price is pretty much going to sit in the same spot. The only thing that's going to offset that balance is what retail traders are doing, okay? But, you know, like with the US Japanese yen, we had a big increase in longs and shorts, okay? And so, but if you take a look, let's take a look. US dollar, Japanese yen, 88 to 100 is 12,000, and this is 11,000. So slightly more longs than shorts, slightly. And we got this move, right? And then we'd have to take a look at the commercials to see what they did. So anyways, we don't have the time to do all the math, but that's what I would do if I really wanted to understand what imbalance there was there. I look at the difference between long and shorts. The difference is 1,000, right? This was 12,000 contracts. This was 11,000. And then I'd look at the commercials and see the difference. And then the rest would be retail traders, what the retail traders were doing. I bet you they were buying past these highs here, breakout, right? Only for supply to come in, and then it's going to drop. So if you want to get to the details, you have to do the calculations like that. But yeah, if it's 1,000 longs and 1,000 shorts, it's pretty much neutralized. And then you have to start trying to understand why they're opening up the same amount of contracts. It's all context, and it's all, you know, where price is and all that stuff. So possibly shorting euro pound would be possible trade. Weaker, yeah, you're right. And take a look at the euro pound. Weekly area of supply and control. Look at those pin bars there. Yeah. That could work out really well. Yeah, exactly, man. You see? Good thinking, buddy. Good thinking. So, but take a look on the daily chart. We have this daily area of demand first, right? So wouldn't we want this daily area of demand be taken out first? And ideally this ascending trend line. So if this gets taken out and this gets taken out, whatever supply zone was formed by taking that out, that would be a good area to short. Yeah. So we'd still want to wait and see how the pound plays out, how it responds to, you know, the US dollar getting weaker, if that is indeed what's going to take place. And we'd want to see how the euro responds, right? So again, I'm expecting this type of move up. Okay. And I'm expecting that move up on the pound too. So let's wait for the moves to take place first. And then when we know that, you know, the trend is going to, or the bigger forces are going to come back into play, because this can come up here and stall at the 20 EMA and then drop. That could happen, or it can go all the way up here. So we want to see how it reacts off of that. The euro, whew, you know, this has already been tested. The only other fresh area is here. Weekly's already been tested, so deeper penetration is very possible. Reaction from here, drop potentially to the demand that caused the break of this, and then target here, target there. Once price gets up here, then I'd be interested in looking at the euro pound to see which one I'd want to short, right? You don't want to short the euro pound when we're expecting the euro to get stronger. Okay. All right, guys, we're at 1 hour right now. That was the webinar for today. I hope this time worked for many of you. I see a lot of fresh faces in the room here, but I also see a lot of familiar faces as well. Those who were able to make the 4 p.m. Time slot. So I hope you enjoyed this webinar, those that have joined us today. And hope it helps you with your trading. Be ready, guys, because I think, like I said, I'm thinking that this is going to happen. On the euro, I think that the US dollar, we're going to start seeing some weakness. Okay. But again, wait for those signs. Trend line taken out, zones being taken out. Once that happens, boom, the floodgates are open. All right, guys, if I missed any questions, I'll get to them. If you posted them within the questions box within GoToWebinar, just repost them as a reply to the post in the private Twitter feed, and I will get to them. All right, guys. Thank you so much for joining me today. Let's see. Oh, there was some questions. Not sure if I was late, but did I miss your Euro USD? I did. You did. Andy, hey, buddy. How's it going? Nice to see you in here. Not sure I was late. Did miss the Euro USD? Yeah. But you know what? I'll make this webinar available to everybody, and I'll post it on YouTube. Okay? So you'll have access to it there. All right, guys. Thank you so much for joining me today. Enjoy the rest of your day. It's going to be a beautiful one where I live. Gorgeous 30 degrees temperatures. So I'll be out taking advantage of that. And yeah, we'll see you in the markets, guys. Be careful out there, okay? Take care.